Hi everyone, my name is David Hames. Welcome to my channel where I try my best to simplify investing. If you like my content, please hit that like and subscribe button. In today's video, I want to talk about selling option premium and specifically a strategy called the put credit spread. It's a great strategy for smaller accounts. And at the end of this video, I'm going to, on my own trading platform, show you how to set this trade up. So stay tuned. So we're talking about selling options, and I think to understand why you would sell an option, you have to understand why you'd buy an option first. So let's say I own Tesla stock. We're going to use Tesla as an example today. It's trading for $247 per share. Let's say I have 100 shares of it. That means I have like $24,700 at risk in this trade. Puts you can think of as an insurance policy. In the event that the stock goes down, you can pay a premium that will guarantee you can sell that stock at a certain price regardless of how low it goes. Let's say that I own Tesla stock and I'm a little bit nervous about it going down, so I want some downside protection. Maybe I'll consider buying a put. So let's say that I buy the July 21st expiration 215 put. I know because I just looked it up, it's going to cost me about $5.85 per share times 100 because there's 100 shares in one option contract. So for this downside protection, it's going to cost me $585. The seller is going to collect that $585. So as long as Tesla at expiration stays above 215, the seller is going to keep that premium. Now in the event at expiration that Tesla is at or below 215, so in other words, it hit the strike price or it's lower, I get to sell my shares for 215 regardless of what the stock price is at. It could go down to 100. And because I bought that 215 put, I get to sell my shares for 215. So this is what that trade looks like from the seller's perspective. When the seller sold that 215 put, Tesla was at 247. The seller sold that put for $585. They collected $585. But then at expiration, 7/21, I said as an exaggeration, this would be an extreme outlier move to go from 247 to 100, but it's possible. That Tesla at expiration was at $100. So the seller now has to cover the difference between the 215 and 100, which is $115 per share. That means the seller is responsible for this $11,500. The seller did collect that $585. So from a total loss perspective, it would be $10,915. So that example was an undefined risk trade. The seller of that put had virtually unlimited downside risk potential. And in order to sell a undefined risk trade like that, which is also called a naked put, you have to have a substantial account to be able to withstand a big move like that. But that's where the put credit spread comes in, because it kind of evens the playing field for everyone. And even smaller accounts can sell a put by using a credit spread. I'm going to show you how. So we're going to sell a put as a put credit spread. The same type of idea that we're going to sell premium, but we're going to do it with defined risk and limit the amount we can lose. Unlike the previous example where it was undefined risk. So we got Tesla at $247. We want to sell the 215 put. I know that we'll collect $5.50 or $550 per option contract. But instead now we're going to buy the 210 put. And it's going to cost us $4.50 or $450, which means we're going to net $1 or $100 collected in option premium. As long as Tesla stays above 215, we keep that $100. If it goes below, that's when we start to lose money. But because we bought this put, if it drops further than 210, this put will go up in equal value to protect us from any losses beyond 210. So our max loss in this trade is 215 minus 210, which would be $5. However, or $500. However, we collected $1 in premium, which makes our max loss $4 or $400. So we're risking $400 to make $100. So is risking $400 to make $100 a good investment? So I want to introduce you guys to a concept called delta, real briefly, because it's really a whole nother video. Delta, and it has to do with probability. And we've been talking all day about how Tesla is at 247, and today is June 12th. And we've been using the expiration cycle 721 and talking about the 215 put. Now the delta of the 215 put is 21. And what does that mean? That means that Tesla has a 21% chance of being at $215 on July 21st. So that's the question. Do you risk $400 risk to make 100 profit? With an 80% chance of success. That's what's cool about options. We have delta, we have probability, we have strategy involved. So you tell me, is that a trade that you make? So this is the option chain. You can see the various dates. We've been talking about July 21st, and I've circled here. There's 39 days till expiration. So once we're in the option chain, you can see on the left are calls and on the right are the puts. So to sell the 215 put, we select the bid price of the 215 put. To buy the 210 put, we select the ask price. Now you can see the 215 put has a -1 that is in red, which indicates that you're selling that put. And the 210 has a green one, which indicates you are buying that put. This is the delta column where it shows 19 for the 215 put, which means there's a 19% chance that Tesla will be at 215 on expiration, which is July 21st. And finally, this summarizes our defined risk trade, or our put credit spread. It shows us that we have a max profit of $100 and we have a max loss of $400. That's my video on the put credit spread. It allows you to trade in big products like Tesla, limit your risk. And we learned a little about probabilities, which was cool. I know this topic is pretty heavy, but I appreciate you guys watching. If you like my content, please hit that like and subscribe button.